just so we don't lose anything as he's joining. So Matt, why don't you tell us a little bit about yourself?
Yeah, so I'm Matt Remuzzi, founder of CapForge Bookkeeping and Tax, and our firm specializes in bookkeeping and tax for e-commerce sellers. And e-commerce accounting is kind of a different animal than the typical Main Street type of business accounting that you might see. And so, that's something that we've really focused in on, being able to help sellers, Amazon sellers, and multi-channel sellers, other platform sellers, really understand their numbers. And to Oliver's point, this is a data business. And to the extent that you can use the data to make good decisions and increase your profitability and make sure that every action you take has a good return on that investment for dollars, for time spent, for products purchased, for product launches, all that good stuff. That's really our goal, is to help our clients be productive and profitable sellers, and not spend time spinning their wheels or investing in inventory that won't move or move as quickly as it should, or basically just not be able to get as much of a return on that effort as they could be. So what I'm going to talk about is 3 key profit drivers that you can look at in your business and sort of look into immediately getting better results out of, immediate fixes that you can implement in the business to drive more profit in the business and drive more growth. And hopefully I can fit all that into my 10-minute slot, but we'll do the best we can with that. But yeah, that's us, CapForge Bookkeeping and Tax. So thanks for managing the intros, Becky.
Awesome.
Yeah, great. We may be able to take over Robert's slot. We may have hours of chat. Matt. We may have him to fill in.
And Oliver, do you mind just giving the elevator introduction again really quickly, since I wasn't recording for that part?
Gosh, thank you. Sorry if people are having to listen to it twice. Hello, I'm Oliver. I'm the CEO and founder of Suite Analytics. We are a customer marketing analytics platform. We work with e-commerce businesses in order to plan and structure their growth. And in particular for today, I want to talk about the need for people to be multi-channel. So that's both e-commerce and Amazon is the primary focus. And I think the really interesting thing here is about the data that's now available to go across the two channels. And that's the particular thing that I'm going to talk about today.
And then Nadav, do you mind introducing yourself?
Yes, hi. I'm Nadav Gorlicki, founder and CEO of CapEc. We set up CapEc 2 years ago in order to really give a financial solution for online sellers. This industry doesn't have a lot of financial offerings when it comes to growth and leveraging your capital. Personally, I'm a seller for over 10 years, multiple brands. And really the importance that we look at is, like we were talking a lot about the data, we're very data driven. We look at all the data of the customer and the exact product that he wants to sell. And we connect with them. We basically partner with them to buy that inventory. So in that way, we're lowering the risk because we can take most of the risk at a small amount of the profit. And the most important thing is that we connect directly with their cash flow. And that way we are able to pay the suppliers when they need to be paid exactly on the dates. And the repayments are only made according to the sales rate when the product is sold. And managing the right cash flow when you're managing an Amazon business or any e-commerce business is extremely hard because you have so many ups and downs of expenses, and return on investment can be very long, 6 to 9 months usually from manufacture date until you actually get it back. So having the right finance solutions that connects directly to your cash flow, creates steady cash flow in your business, allows you to be stress-free and to be able really to concentrate in marketing and growth and expansion of your products, knowing that you have the backing to buy as much inventory as you want without having any cash flow restraints.
Awesome. And I'm Becky Trowbridge. I'm the digital marketing manager at eComEngine. We make software for Amazon sellers. Feedback 5 and Seller Pulse are available in 17 international marketplaces, and Restock Pro is available in 10. So we support Europe as well as the US and several other marketplaces. But we help you get feedback and reviews for your Amazon store, manage your FBA inventory, and manage and protect your listings. And today I'm here to talk about the buy box, which it's a hot topic all the time. And Robert, I'm going to hand it back to you. I just kind of took over since we were having some tech issues. So we just introduced ourselves if you want to kick it off.
Thank you very much. Can you hear me? Hopefully everybody can hear me now. So sorry about that. I was having some technical issues. Like that's obviously going to happen on the first one that I do. So, but yeah, good to meet everybody, and thanks very much for joining everybody. Much appreciated. So, yeah, today my name is Robert, and I run MrPrime.com, and we're a full service agency that help sellers basically scale globally. So, in a nutshell, we do everything end to end. And help sellers expand globally, expand from the US to EU, but also to expand both ways and effectively grow their sales globally. So I wanted to talk today about effectively basically smaller markets like Germany, France, Italy, Spain, UK, and how they compare to the US, and some stats that I pulled together around them. So I'm going to share my screen now. So let me see. Okay, if you sorry, because I'm not the host anymore, would someone mind just enabling screen sharing for me, please, if that's okay? Sorry, I don't know if you don't see that one.
Trying to see if I have any.
Meanwhile, while that's happening,
I've got the same disabled. I can't do it, Robert.
So meanwhile, there's a question for CapEc. Do you work with FBA sellers, basically? So that was just while that's happening, but I don't know how to enable the screen sharing on.
I can answer that on the chat, no problem.
Okay, thank you. Thank you, that's enabled. So let's see. So basically, here is my screen. 1 moment, move this out of the way. So what I did was, we work, obviously, let me hide this out as well. We work with a lot of sellers on Amazon, and myself personally, I've sold in Amazon US and the EU. And one thing, that I would say is that a lot of the profit that I made as a business, and a lot of the profit that we see, for our clients, they're actually making more money in the EU, comparatively in a profit sense. So what I did was I pulled together some stats from 10 of our clients. I won't name them, but I've just merged some stats, and I also pulled together some stats from 10 industries that I saw, on Amazon. So I went into them and I looked at the USA, and I looked at Germany and the UK, and did some sort of comparative analytics, basically. So first of all, in the EU and German markets, there are some opportunities for USA sellers, such as premium pricing opportunities. If you sell, for example, in Walmart and other things in the other places in the US, there's often going to be price matching issues, where Amazon's going to make you, hold to a certain price, on your listing. But obviously, when you sell abroad in markets that are foreign to you, you don't have those constraints. So some sellers that I work with, basically put the prices up about 30%, in Germany and the EU markets, and still sell well, there despite that. So that covers a lot of costs in those markets. The other thing is there's a lot of, there's a lot of untapped potential there, because effectively, it's a place where, the US has obviously got the most sales, which I'll get into in a minute, but in these EU markets, they're less competitive. There are higher barriers to entry to actually get into them, and so therefore that puts people off doing that initial work. And another thing is, it's obviously good to diversify sales channels. It adds value to your business. So effectively, I found, again, look, in my business personally, before I got into an agency, we actually made more profit in the EU compared to the US, and again, that was due to things like costs of advertising in the US being quite saturated, obviously a much more competitive market, sort of driving prices down and so forth, and the barriers to entry that I've spoken about. So here's some data that we found on it. So basically, on the 10 markets that I looked at, now this is not to be taken as complete gospel over every market, but this is 10 prominent niches, and this is based on my experience as well. We saw that in the European market, there was a 24.6% higher price than the US, for the products and the markets that I was looking at on average. So people were able to price higher, effectively. After that, obviously, in terms of reviews, the products in the US, if a product had 10,000 reviews, the comparative average in Germany, for example, would be about 3,400. So we found that in the 10 niches that I looked at, and they were quite broad, and they weren't too specific. There was a 2.9 times lower review count in the US, and that means that if you're in the US with a lot of reviews, you can bring them over to the European countries, and and basically you come in there with a big competitive advantage. There's a much smaller barrier from a review perspective to go and compete in those countries. In terms of sales, though, obviously US is the king. The ones that we looked at, and this ties in with the data on overall sales on Amazon, in terms of the multiples, but we saw that Amazon sales were 11.2 times higher than the comparative sales, in the other countries. So obviously it's the beast, and and we know that, but that's not to say that there isn't a lot of margin and profit still elsewhere. One thing that was interesting was that again, in these 10 niches, and I'll show the niches, in a document afterwards, but the top 3 products in the USA market, 32% of the sales were dominated in the top 3, and by contrast, in the European market, it was a lot broader. So only 16.8% of the total sales were in the top 3. So it meant that effectively, if you get in the top 3, in the US, you're getting a significant share of those huge sales. But in the US, in the European market, it was a lot more spread out, basically, according to the data that we looked at. And again, in the search trends, we looked at in the US, they were leveling out or slightly declining, and in the European market, Germany especially, they were on the increase, and that sort of ties into, I think, a lot of European expansion. People moving, from what is a saturated market, and again, this is based on 10 niches, so I will stress that this is not data across the board, but this is what we also see as a business as well at MrPrime. This was my own business, and this was also collated from some of the other things before and the clients that we had. So Germany average net profit was around 28%, USA was 22%, and UK was 21%. And those are the sort of trends that we see, with the clients that we have as well. And again, the ACOS is partly to do with that, and also it's the ability to price at a premium rate. So obviously the ACOS ads and so forth were higher in the US, and and with all the things that we've mentioned, a little less competitive in Germany and the UK. So another good reason to go there. Basically, to get into the UK market and the German market, in the UK, one of the main things, you've got to register for VAT, to gain access into the UK market. And since Brexit, it's made it a pain, for the German market as well. So registering for VAT in Germany to gain access there would be my recommendation to get started. And that gives you access to France, Italy, Spain, Netherlands, Belgium, Poland, Sweden, and more. And from those, you can then go into register in those individual countries if they start to show promise, but you can reach them all from the German market by registering for VAT, and that takes around 3 months. And I'm not an expert on that, but we work with experts who are. Overcoming barriers. Well, there's nothing like, if it was easy, everybody would do it. And there are a lot of barriers to getting into the European market and, getting into the UK. Compliance is a major one. Depending on the category that you're in, there is quite a lot of compliance to consider, things like product regulations, packaging regulations, and so forth. There is quite a lot to go through. And then you've got translations and localization. There's going to be some specific nuances to those things that you're probably going to need expert advice on. And that's, again, we work with partners who do all of those sort of things. And then finally, logistics and fulfillment. You can send it direct into Amazon FBA, of course, from your Chinese warehouse or wherever. But as you progress and grow in those countries, it's probably worth looking at a third-party logistics in somewhere like Germany, Amsterdam, somewhere quite central to get into Europe, really. So there are definite barriers there, and that's why, if you're prepared to take the pain at the start and go through those barriers, it can really open up a far less competitive space, in my opinion. So basically, lastly, first mover advantage, is key. It's not first mover. It seems silly talking about that after so many years, but it's comparatively to the US, it is still early days, I would say, in the EU, and it's still growing fast. And then building a moat around your business. Again, a lot of people won't do it. The VAT processes, can be laborious, the logistics and all the new territories. But once you're there and set up, you really can go in and grow. And that's what a lot of sellers are doing very successfully. And again, this is just a summary, of basically, what for many USA sellers, they start with the domestic market and then they start to expand outwards, and and that still now even drips into smaller territories like Belgium and Poland and so forth. With that said, I've actually written a document on the regulation side of things, which is really boring, but I will share it with anybody who wants to email me, robert@mrprime.com, and effectively just goes through the different regulatory requirements. And again, that's not coming from perspective of a complete expert. It's just listing the things. If you want to get, if you want to know a contact who can help you with all those things, I'll happily put you in touch with them. But in summary, I just wanted to say that, in terms of being smart, business, in my opinion, it's competing in pools where you can really, and going into markets in the US and things like that, especially if you're a new seller where reviews, there's 10,000 average reviews and things like that, is it's going to be very difficult. So I do think considering these markets and how fast they're growing, makes a lot of sense basically. So yeah, that's all I wanted to say around that really. So and if anybody wants these slides and things like that, please email me rob@mrprime.com or any advice, and I'd happily take a look for you. Thanks. Okay. Yeah, so that was my presentation on the EU. Just let me find out who is going to be next for my notes. One moment. So next up, let me see. We have Joe Salter. Is Joe there? And that's talking about accounting for all fees when setting a price for products.
Yes, I am here. Can you guys hear me and see me?
Would you? Yeah, sure. I can hear you.
Okay,
If you'd like to
great.
go ahead and share your screen. Thank you.
Sure. So actually, I don't have a share screen. I was just going to kind of talk through some of the things that I see, obviously, as the co-founder of Riverbend, which deals with hundreds, if not thousands, of Amazon sellers a year. Riverbend primarily focuses on account health and listing takedowns, ASIN takedowns, IP-related issues, and account takedowns. But with that, I'm also about a 10-year seller. So I've been selling on Amazon US for about 10 years, and I'd like to talk a little bit today about some of the things that I look for and what I've learned from years and being in the consulting business, of really what to focus on when you're selling a product or even choosing to sell a product. So in the US, there are, and I know it's different in other countries, especially in certain categories like apparel, which Amazon came out with some new fee structures and referral fee structures over the last few months, where products under $19.99 and $14.99 have lower referral fees than products over $19.99. So the apparel fee structure is 17%, and then plus your FBA fee. And now in the US, we have it's down to 10% on $19.99 and 5% on $14.99 and below, which is it's a game changer, because basically on things that maybe you would have sold as a single in the past, or you would have had to make things a 2-pack or a 3-pack to kind of try to get the AUR up, now you could really sell things at 14 and 19 and still make a little bit of money. And what I want to try to do today is explain some of the things that I look at before I even decide a product to launch or to buy heavy into. And some of those things are taking into account seasonality, because if you're going out of a season, or if you have a short season for the product that you're selling, especially now with the long-term storage fees starting after 180 days, as it used to be after 360 days, you could start to really rack up long-term storage fees. In addition to long-term storage fees, there are regular FBA storage fees, which again also used to be lower a few years back, and now they've creeped up. So every product is different, obviously based on size and weight, but the average that I've seen is somewhere between, I don't know, around 15 to 22 to 25 cents a month per unit, where it used to be a lot lower. And those fees 4x during fourth quarter. So October, November, December, those fees are 4x. So if you're thinking about selling a product and you're looking at your retail margin before regular FBA fees, before long-term storage fees, especially if it's a seasonal product and you know it's going to slow down towards the end of the selling run, and then you're going to have to hold on to it at Amazon at FBA for a few months, then that could really hurt you. And I think you need to put in some type of buffer in your calculations to make sure that you're accounting for that extra long-term storage fee. Then obviously there are advertising costs. There are placement fees when you're sending product into Amazon, right? So the trucks or UPS that you used to send in. That also used to be a lot less. Now there are placement fees that you really can't avoid, and that's somewhere between an additional 15 to 35, in some cases 45 cents, depending on how many units you could fit in a container or on a truck. And then on top of all that, there are returns. And that's actually what I really wanted to focus on. I actually feel that's something that almost no Amazon sellers focus on enough. And it's actually something that we talk about internally a lot in our Amazon retail business, is the margin impact that the returns have on your business. So a lot of people will think, okay, so if something gets returned to me, I'm getting a lot of the fees back and I'm not really losing that much. Well, that's not really the case. You're really only getting the referral fee back, but the FBA fee that the goods, that the shipment went out for, you're not getting that back. And now, as of January, Amazon added another fee called a return processing fee. That used to be a very low amount, and now it actually went up a lot. So that could be as high as 6-7% of the total sale. So a lot of people don't understand, but if you're having a return rate of 6, 7, 8, potentially even 9%, especially in shoes, clothing, seasonal products, gift giving, return rates are very high. I've seen return rates as high as 15 to 18%. The margin impact of those returns can be close to 50% of the actual return rate. And obviously you have to take into account, and you can run reports in Amazon of how much of those goods are going back into your stock and how much of those are unfulfillable or unsaleable. That's also very important, right? Because even though you lost the money on the sale, in some cases, if the inventory is good and Amazon deems it as saleable, at least your inventory value goes up. It is on a different line in your overall profitability. That's actually on your balance sheet. If you're running your business, you have to know the difference between the balance sheet and the P&L, but your balance sheet inventory goes up, but your P&L, that still gets hurt because of the return. So we've seen, margin impact as high as 50% of the return rate. So if you think you're making 25 or 30 points gross on a product, but you have a 15% return rate, you could potentially be getting a 7 to 8% dip in margin just on the returns. So these are the things that I think are very important. Obviously, looking into why the items is being returned, seeing if there's anything you could do to the listing to make it more clear, to call out the features, to call out maybe fit or sizing or anything like that is super important to bring down that return rate. And then really overall, something that I think Lauren touched on earlier was the advertising fees and the advertising cost per click in the US has really gone up. So taking that into account when you're about to launch a listing, or even if you're a reseller and you want to revive an old listing, I think putting that into your calculations early on with the cost per unit, kind of almost like adding it to your cost of goods, is important, because if you know it's going to cost you about $1 to $1.50, maybe even $2 per click to get views on your listing, that doesn't come for free. That's going to come off your bottom line. Now, eventually your item might get obviously more organic rank and more placement on organic searches. But if that doesn't happen, you might be living with those advertising fees for the longevity of your inventory. So taking that into account as well is very important. Now, the reason why I didn't want to, show a huge spreadsheet and kind of put all this, I think that can get overwhelming. I really like to look at this in a very practical, logical way of thinking of these items as line items in your business and expenses. So instead of looking at them as external fees, if you look at them as part of your cost of goods, of doing business, you can really have a very accurate understanding and a very accurate figure of what your true profitability is. Sorry, Becky, that's all I have. Thank you for listening. And if anyone wants to reach out, I believe I shared my contact information. If it's not up, it's joe@riverbendconsulting.com, or you could visit our website, riverbendconsulting.com, to talk to any of our over 100 ex-Amazon people with experience between third party sellers and seller performance experts, and all different types of positions that they held in Amazon. So we have a ton of experience dealing with all issues. Thank you.
Awesome. Yeah, thank you, Joe. That was really interesting. So yeah, really, really insightful. And it's the stuff that a lot of people don't know when they get into selling, on Amazon. I think, it's not very known to build those sort of costs into things immediately, like building an ad cost and so forth. So that's very insightful. Now, yeah, Becky,
Laurent,
I've actually
been told I usually bring up the annoying things that people don't want to hear about. Obviously, everyone wants to hear about the fun stuff and the growth and the sales, and they always want to look at that chart that just goes up and up and up. But if you're not really looking at your profitability, those numbers are not real. So I hate to be the bearer of bad news.
People are always shocked when you show them what their actual profit is, if they're not on it, if Amazon's another channel and they actually see, my goodness, we're in the, yeah, they're very shocked when they build it all into the things. So it's vital information for for anybody selling. Yeah, Becky, would you like to, and by the way, I'll put in the contact details in the chat after this for everybody. So but yeah, Becky, would you like to carry on now and do your presentation, if that's okay? Thank you.
Yeah, so I'm going to talk about the buy box. And before you tune me out, even if you are the only seller, you can lose the buy box. So we're going to talk a little bit about that and why you need to be paying attention to the buy box as you're trying to turn your data into dollars. So just kind of wanted to go over some basics. This is probably old news for a lot of you. Oh, sorry. But just wanted to talk about buy box eligibility to get started. So if you're not eligible for the buy box, you can't win it. You need to have a professional seller account. You have to have inventory that's available. Your order defect and return rates, like Joe was just saying, you really want to watch those return rates now, especially now that returns processing fee is in effect. You need high seller performance metrics. So one thing that Amazon particularly looks at is your seller feedback score. A lot of people confuse feedback and reviews. This is kind of what I talk about all day, every day. So feedback is about the experience with you as a seller and with your business. And then that can also include like packaging issues and fulfillment issues. And then a product review is actually just a review of your product. So those are both very important and they are different. They're both 5 stars, and we kind of interchangeably talk about ratings, and feedback and reviews kind of get thrown together, but they are different. Your history selling on Amazon can also impact whether or not you can win the buy box. New sellers sometimes have a harder time getting buy box share. And then you need to have fast and free shipping available. And some of the ways to win the buy box are making sure that your listing is accurate and optimized. We always talk about, especially from the review side, you're setting the customer's expectation with your details in your product listing. And if you have inaccurate or out of date information, or you don't have like images that really show how your product works and things like that, it can make it confusing for buyers. And then sometimes that results in negative reviews, which none of us want. Having consistent order volume is important. If your order volume starts to slow down, you might want to think about running some advertising or looking at other ways to promote your products. I know working with influencers and a lot of off Amazon, promoting people coming to your Amazon page is a great way to do that as well. You need to keep your product in stock, keep your account health strong, like we just mentioned, and then competitive pricing is a big one. So Amazon, at least in the US, and I'm not as familiar with how this works in the EU, but in the US, if your product is listed on another platform for a lower price, Amazon will actually remove you from the buy box. So that leads us to losing the buy box. And that's called buy box suppression. That's one of the most common reasons that people lose the buy box. Unfortunately, as we all know, Amazon repricing happens very quickly. It's hard to stay on top of all the changes. And so if you're not monitoring the buy box, it's really easy to not know that, or to not realize that you don't actually have the buy box. And since I think BigCommerce reported that it's like 86% of sales go through the buy box on Amazon, if you're not in the buy box, you're really seeing your sales decline. So that competitive pricing issue is a big one. Pricing issues in general can cause you to lose the buy box, not being eligible, all those things that I just listed. Having low sales volume or Like if your listing isn't fully filled out, if you're not Prime eligible, low inventory, your account health has gotten bad, say your seller feedback rating went down or your order defect rate went up, that can impact whether or not you win the buy box. And then we get into hijacked listings, unauthorized resellers. You can have all kinds of threats against your winning the buy box. Sometimes it's just a matter of geography. If the fulfillment center that your product is located in is far away from someone and another seller has the same product in a location that's closer to them, they would probably win the buy box, because we all know that Amazon values that fast and free delivery and they want to make it as fast and cheap as possible. So we have a tool called Seller Pulse. We're really excited about it. It started out as just monitoring your listings, and then we've recently added some really cool features related to the buy box. But this is actually an example from Seller Pulse showing what happens when the buy box is suppressed. We actually email you and let you know what the price is on another platform. So that's that competitive price threshold. And then also things like seller rating. We now include seller name, and there's a lot of detail. So if you needed to send a cease and desist, we would have the address, and there's a lot of great data there. But yeah, turning your data into dollars is really important, whether you're using software like Seller Pulse to monitor your buy box or whether you're doing it manually. There's a lot to keep track of. So really making sure that you understand the competition is key, because in some cases it might not be worth it to compete, right? Like, let's say this winning offer was Amazon and they were beating you on price and they were beating you on seller rating. Maybe it's not worth it. Like, maybe you just let their inventory deplete a little bit and then you reconsider your price. On the other hand, there might be someone that you're competing with where, like, for example, here, I see that my positive feedback is not great. So the best way that I could compete is to try to get more feedback. And now that's kind of a long game. I'm not going to be able to change that overnight, but I know that it's something to work on if I want to win the buy box more often. And I know that it's something that's causing me issues. And then here we actually have a lot of details that are able to be filtered. We pull out the losing offer details so that you can see everything that's going on. We've got a nice graph showing when you're winning, when you're losing, and when there's no winner, which can also happen, so that you know what's going on with the buy box and what you can do to try to improve things. And then on our alerts log, we actually have the ability to download all of this to CSV, and it's filterable, and it's just a more detailed record. So you can look over time and really dig into that analysis of what could I be doing to improve my business? What can I do to win and keep the buy box as much as possible? So when it comes to turning your data into dollars, you need to be paying attention to the buy box, because like I said, that 86% metric is really key, and we want to make sure that you're getting as much buy box share as possible.
Awesome. Yeah, that was really useful. And we do have the same problem in the EU and UK with competitive pricing. It's like it's a real issue. So
Stressful.
yeah, it's a real pain. It can be really a thorn in the side of sellers, really. So especially, like price matching boots and things like that in the UK, where it's like a big thing, and it causes a lot of problems. So it'd be that would be really useful to see what the competitive price is.
Lauren, I have a question
so-
for you, if you don't mind. I think you had mentioned this, and also Becky, I don't know how much experience you have in the EU. How would you compare ad costs or ad cost per click, US to EU? And I know maybe every marketplace is a little different, but at certain times a year, it's almost inhibitive in the US to really push ads heavy. It just destroys your profit. But I feel like, and I've seen it in Canada and Mexico, I haven't done a ton in the EU, so I don't know. What are the costs like? And is it digestible?
Oh, is that to me or Becky? Sorry.
To you, I think.
Either one of you guys, more you, I guess, if you're more experienced in the EU. Like, what are the costs per clicks average over there? Like, can you run an ad all day for a few $100s, or like it's like in the US where it would cost you thousands of dollars?
Yeah, I mean, it obviously it's niche dependent, like obviously, but it's a lot cheaper. It's a lot cheaper than the US in my experience. So you can run ads all day, and in the US, we find that, we're either running ads for ranking purposes, or, we're trying to work out why we're running the ads rather than just running ads for the sake of it. So some people just put an ACOS of
Yes.
let's have a target ACOS of 30%, whatever, but is it to get that first customer? Is that why you're running high ads? If got lifetime value, customer value, is it to rank better for certain keywords if you've got an exact match? But effectively, short answer is I think it's still a lot cheaper in the UK and EU for sure. And the US is, if you go into the US, for example, you say standing desks and you try and bid on the term standing desks, and you're going to blow your budget immediately. So so if you're trying to do it for ACOS, I think it's probably about going a bit deeper into the long tail. But yeah, it's cheaper. It's getting more expensive over here though. That's for sure. So it is definitely getting more expensive everywhere. But we're not in your US levels yet.
Yeah, we utilize a lot of the top of search multiplier. We find that especially when a customer is seeing us first, our click-through rate is higher. And when our click-through rate is higher, it'll yield better results with organic rank. So even though it is more expensive, you don't have to do it forever. As long as you do it enough in the beginning and in the honeymoon stage or in the early stage, it really does help with the organic rank. Do you find that as well?
Yeah, no, absolutely. We definitely find that, and also that things like video ads often work really, really well in a lot of the niches that we work in. But quite often, a lot of you get me into the PPC. But once, if people work with agencies and they're just PPC, I feel like often the vital thing is the conversion rate of the listing and the click-through rate of the listing and so forth. And so in my mind, they work together. If I had an Amazon business, I probably would not just specifically hire PPC only business. That's just me, because I feel like they work with the listing, the brand. You have to know the nuances, the seasonality, all of that sort of stuff. It's a complex thing, and I'm not an expert at PPC. We have people that are, but I know enough about it to know that it's very expensive in the US for sure. And so it's but I do like to have a reason for running it, as in, is it profitability, is it sustained growth, is it ranking? And so we measure the TACOS, is obviously the key metric, the total ad cost of sale, to make sure that that's in line with with the growth that we're already. But yeah, it's pretty brutal, and it's not getting any better. That's for sure.
So something I like to tell a lot of people that use agencies or marketing agencies, because they are intimidated by running ads themselves, which I don't blame them. There's a lot to do in a business. You have to source, you have to to develop content, to all that. I totally get it. But when you fully hand off ads, if you're not meeting with your ads agency almost every other day and supplying them with inventory levels, your purpose of the listing, your goals of the listing, it's not just an ACOS thing. I've seen too many times where marketing agencies would be pushing product that you have very low inventory on. And I'm like, but why are you pushing that inventory? Why are you selling it faster at a lower price, at lower margin, if you don't have much left? You really need to know where you want to spend, not just on a listing level, but on a SKU level as well.
Yeah, that's so true. It's like, and a lot of the time, I guess even agencies maybe don't do that as much, to be quite honest with you, like in terms of, how much stock do you have, looking at product by products, ACOS, and looking at, as well as all the various ad types, is much more complicated than a lot of people think. So, yeah, I agree with you on that. Sorry, Oliver. Yes.
Yeah, I think just the point I always go on about is actually looking at, you mentioned the customer lifetime value word, or phrase, or whatever it is. It's such an important element to add in on top of this, because as we all know, there are scenarios where it's right to recruit customers unprofitably, but as long as you understand what the customer lifetime value is. And the biggest mistake I find so often is people not working off customer lifetime value, and you mentioned it there, Rob. And yeah, it's such an important concept, that Joe, as you say, we all know it's unbelievably expensive, whether it's in the UK or in the US. But the metric I find so often missed out from people is that understanding customer lifetime value.
Absolutely, and especially if you've got filters and inserts and things to try and get people onto a list, and you're using Amazon as an acquisition channel, and then you've got to follow up so you know that customer is then going to be potentially upsold, and and so on. Then it justifies the ACOS. But again, most sellers don't have that. It's quite an advanced thing, I would suggest. But it's something that again, it justifies running the ads.
It also really applies to subscribe and save products like supplements, soaps, shampoos. That's when you really can afford to spend a little bit more, because if you can get them in there's a chance that that person can be ordering from you for the next 12 months. So you can't look at it as, oh, I spent $3 on the click and it took me 10 clicks and I spent $30 and I really lost $20. No, if you amortize it over a 12-month, sales, you probably made out like a bandit. But if you're not analyzing it the right way, you might not be pushing the way you should be pushing.
Yeah, I don't know how accurate those tools are in Amazon yet about lifetime customer value. Not not that accurate from what I can see. But yeah.
I mean, so just to add in, I mean, slightly putting my in about Suite. So we have an Amazon feed. We're a customer marketing analytics platform, and as probably everyone knows, there's a unique identifier for every customer. Now it's a hashed email. It's not so for in an e-commerce world, it's not like having customer data that you're used to, but all those same metrics around customer lifetime value, repeat rates, all those things are accessible in a platform like Suite, because it, for me, I'm an e-commerce retailer rather like all of you guys who are Amazon experts. My real background is in e-com. But you need that. You need, in my opinion, that is the lifeblood of making decisions, and that's why we believe that it's really important that you have access to that same information, both for your e-com business and for your Amazon, even if it's anonymous. So yeah, I think we can do it better than the AMC tools, but that's how we operate.
Perfect. Sorry for the digression, but I guess it would be good now, Oliver, to hear about how you combine, e-commerce and Amazon and so forth. If that leads nicely onto that, if you don't mind. But
yeah, sure. Thank you for that. So, it's really interesting here. Everyone else's sort of particular specialism. The thing that we're really working on and is that my background, as I said, is e-com, and so we're really used to Suite. It has all the first-party data that you would get from e-commerce, and really what we're working is that crossover into Amazon, and we've got 3 betas running at the moment. The first thing is pushing your existing customer file into AMC in order to be able to suppress marketing to existing e-commerce customers. Going back to Joe and everyone else's point, profitability on Amazon can be much lower, and so there are very few brands that want to switch their e-com customers into Amazon customers. So that's a really important use of first-party data, and that's just a simple customer feed going into AMC. The second scenario that we're working on, and this is obviously for people a bit larger using DSP, is again being able to, a bit like old Facebook world, where you could provide audiences into DSP for those to be then used as the source for creating those DSP audiences. So we're particularly doing things like particular product groups feeds or best customer feeds. We're pushing into AMC and then into DSP. So those are the 2 primary use cases that are relatively, I'm sure Amazon is really warming up on the topic of using first-party data in order to improve performance. And then the third thing, which we're covering off, which it's going to be quite a basic stat, but we're again pushing that first-party data into AMC in order to understand the channel crossover between your e-commerce sales and your Amazon sales. Now, stat that comes out of that at the moment is purely that unless your 6-month file, you have a 30% match rate or whatever. But though it's a rather basic stat, it's a stat that I think most e-commerce brands want. You really want to know how many people cross over from one channel to the other. And we're talking to Amazon at the moment about being able to add the next layer of data on that, as in the sequencing of what those crossover of orders are. So effectively, is it your Amazon crossover orders, customers moving over to ecom, or the other way around? And that would be definitely an additional layer of insight that I think all brands would want to understand. So those are the three things that we're really pushing about using data from ecom into Amazon. And I think there is a general move, as everyone probably knows, of AMC being more open, being able to use data better. So we at Suite are really trying to be at the forefront of that, because ultimately, whether whichever channel you're driving, you generally need to acquire new customers, and it's really hard if you're working in a silo all the time. So our overall aim is to try and reduce this siloed view of how do customers operate. It's never going to be perfect, because, as we know, Amazon will never give us access to first-party data, but there are beginning to be ways in order to drive your performance using your ecom data into Amazon. And so that's what we do at Suite. We cover off all the ecom side of it, and then that we talked about customer lifetime value, cost to acquire a new customer, all of those key metrics we've now harmonized across the two channels. So that's what we're about, Rob. I don't know where with your agency, we haven't crossed over in the UK, but I don't know whether you guys have started using those inputs.
No, but we'd love to, actually, because it's there are things that we get asked about a lot, and obviously there's a resistance with clients wanting customers to go. Yeah, no one wants to give Amazon more customers. So I try and pitch it as Amazon's a place to get customers, and if you use the right systems, you can actually bring them into your own business and repeat by their, effectively within terms and conditions. So yeah, so it's a constant battle. It's like we don't, and why would you want to, give customers to Amazon? But there are reasons, so that you would try and, in order to increase ranking with attribution, and then funnel them back into your own websites and so on. But so those data points would be really useful. So thank you very much for bringing those up.
Thank you, and I think, Rob, we both know it doesn't work so well if you work in silos, it's not perfect, but the more we can unblock those silos, I think it's better it is for brands. I'm an old multi-channeler, whether it was shops or catalogs or websites. Modern multi-channel is Amazon and ecom, or multiple other partners. So I think it's just really important for everyone to look at their information and their data in a similar way when looking at the two channels.
Awesome. And and if anybody wants to get in touch with you, I've added the your LinkedIn page to to the chat and so forth. So thank you very much.
Lovely, thank you.
Yeah. So next, Nadav, would you like to I know you've introduced yourself. If you wanted to take over, that would be great. Thank you.
Sure. Thanks, Rob. I'll share my screen. Okay. So I'm going to talk about how to scale your business and creating steady cash flow and increasing your ROI altogether. Little background, I mentioned this before, but I'm a seller over 10 years. I also did an exit in a high-tech company 10 years ago, and since then I've been in the e-commerce space, built and scaled over 4 brands. Very, very intense knowledge in the industry. I've been through everything for good and for bad, right? At the end of the day, I think some of you guys mentioned this before. When we're managing an Amazon store, we're basically investing our capital, and we want to get a good return on investment on our capital. We're going to take our money, we're going to use it to buy inventory, create listings, market our product, and we want to get profits or some kind of return on that investment. If we're only making 10% on our capital, you might as well go to the bank and get 6% with no risk and no work, right? So we don't want to be there. We want to be able to maximize our investment and get more ROI. It's very important to understand cash flow when it comes to managing an Amazon business. Cash flow is the most important thing. If you don't understand your cash flow, then you'll find yourself at points when you have to either pay a supplier or pay even your employees, and suddenly you don't have enough money in the bank, and therefore you're always stressed and you can't really concentrate on the positive side of the business. You're always putting out fires, you're always trying to get more money, you're always postponing your payments. You're dealing with this on a daily basis. It's not a healthy way to manage your business, and it's something you really want to try and fix before everything, because that's going to be the core of your success. If your cash flow is steady and accurate and you're able to manage it in a good way, then of course you'll be able to manage yourself and the other things much better. So when we're a seller, the ROI timeline, especially for manufacturer and private label, is very different than a lot of the other businesses out there. You're gonna make when you want to make a manufacturing order, usually you have to give 30% down, and then somewhere between a month or two later, that inventory might be ready. Sometimes there's problems. It might take an extra month because Chinese New Year's in the middle or something like that. So then you have to pay 70% on that on the manufacturing. After that, you usually have to pay the shipping while it's being shipped. This can take between 3 weeks to 6 weeks, depending on delays and where you're sending it to. And then hopefully you bought an amount of product that will sell within 4 to 6 months. I don't recommend buying much more than that. You can always place more smaller orders and not have your capital tied up in inventory in very expensive FPAs or warehouses. You want to try and keep that inventory flowing in the minimum amount of time in Amazon and to get it sold as fast as possible, because that's when you get your ROI. That's when you start making your money back. So this is very important to understand, and everybody needs to know these payment dates because these are the most substantial dates in your cash flow. And when you're managing an Amazon business, 80 to 90% of your capital is gonna be tied up in inventory. And also, in most cases, you're gonna have 2 to 3 orders in parallel because you're gonna have one being manufactured, one just arrived at Amazon, and the old one is now still last inventory being sold. So you're always gonna have at least 2 orders in parallel, sometimes even 3, and it gets a little bit complicated to remember all the dates when you have to pay the manufacturer, the shipping, and to make sure you have the cash flow to do that. So most businesses in the world use funding. I mean, even huge businesses like publicly traded companies like Google and Microsoft, they're publicly traded in order to get money from the public so that they can grow their business. So using external funding is a basic of any business, and I feel that it's something that the Amazon space and the e-commerce space doesn't use enough, because usually it's a lot of people that started as employees. They started this as a side job. It grew, it's successful, and now they're trying to manage that capital. And a lot of times you'll go and you'll take a loan on your credit cards, mortgage your house, do all these things in order to get more capital to grow your business, where there are solutions out there, and you should definitely try and find them. Because if you can find the good and the right type of financing, you're also mitigating risk. I mean, if you find a financier like we do, we partner with our sellers that's taking the risk. The only collateral we take is the inventory itself, meaning if that inventory doesn't sell, we'll take it over, we'll help get rid of it, we'll help sell it, whatever needs to be done. We won't come and take your house or your car or anything like that. So where you're mitigating risk now. Instead of putting $100,000 of your own, you put $30,000, and if something goes wrong, you only lost $30,000. That's on the one hand of it. The other hand is, of course, growth. I mean, on average, if a private label seller should be making anywhere between 70 to 100% ROI on his cost of goods. But the time frame of that is usually 6 to 9 months from when you placed your order and until you sold off that inventory. Meaning at best, you can run that 1.5 times a year. So at best, you can double your capital every year. And that's before even having to do multiple orders in parallel. So there's no way that any seller can meet the potential growth of its store without adding capital to his business every year. Because usually if you're running a business and you want to grow on Amazon, you can grow times 3, times 4 a year, which means you're going to need minimum times 3, times 4 capital every year from what you have in your business. So you need to plan this ahead and hopefully find a partner that can give you that capital, because without that capital, you're basically not going to be able to scale, not going to be able to grow. You're going to find yourself running out of inventory. You did huge investments creating assets, which is keywords ranking, reviews, positioning yourself organically, and then you run out of inventory and everything falls back and you have to rebuild it again. So it's running out of inventory is probably the worst thing that can happen to you. It means you have a good product, people want to buy it, and you don't have the supply to give it. So you always want to be able to bring as much inventory as you can, and finding a good partner that can help you with that would be a great solution. The other thing is, in this space, most of the finance solutions that are out there are revenue financing. Revenue financing basically look at your sales, say, hey, if you're selling $40,000 a month, we'll give you $40,000 and we'll take it off in the next 6 months. Amazon used to do those fundings too. They're stopping to do that now. These type of finances are really not good for inventory. In fact, they'll even harm your business, because if you have today $10,000 and you want to buy $50,000 worth of inventory, and you go and you get revenue financing and you go and place the order day one, you're going to give them the 30%, $12,000, but already before the product's ready, Amazon's now your finance company is gonna take off from the revenue the first payment, and now you don't even have the $50,000 to pay the remaining amount of the inventory that you just purchased. Not to mention that after that, you have the shipping, all this time. Basically, until you sold your first product, it could be 4 months, and you haven't even, and the revenue financing, you almost had to pay it all back, and you didn't get any ROI yet. So if you invested that money, planning on the profits of that inventory to pay back this loan, you're not going to have it in time. The return rate doesn't match your ROI, and therefore you're going to create more cash flow restraints, and this can collapse a business. I've seen it so many times. People take revenue financing, go to buy inventory, the return doesn't match, the cash flow doesn't work. They take more revenue financing just to pay back the other revenue financing, and they start going into a snowball of bad financials. So the most important thing is really understanding the type of financing you're taking, and that it connects directly with the return, with your ROI and your cash flow, so you know you can pay it back. When it comes to CapEc, we work very differently. We partner with you on your PO. So you come to us, you say, hey, I want to buy this product. I want to buy 10,000 units. It's going to cost me $100,000. I have $30,000 to buy this product. We'll look at the PO. We check all the data parameters of that product. So we check profitability. By the way, this is sort of like an audit on your product. We look into all the aspects that everyone was talking here, your ACOS, your TACOS, your profits, your cost of shipping, your logistics, your competition, your reviews. We look at everything, and then we decide if this product really has good potential and is selling well. And if it does, then we'll approve joining you on this PO, and we'll approve, let's say, 70% of that financing. So you know now with confidence, you can pay the manufacturer the 30% deposit, and we'll pay the 70% when the product's ready. So even if it was delayed now, it took an extra month for the manufacturer to finish the manufacturing, it doesn't affect your financing, it doesn't add any fees. Basically, the deal didn't even start. And also, if you have payment terms with your manufacturer, meaning you have net 30, net 60, which is always something you should try and bargain and get as much as you can, because that's free money, will connect to that payment plan. So, and that will even lower fees even more. And then we pay the shipping when they need to be paid, and we build the repayment plan to match the sales rate. So it's actually when you sold a product and you got ROI on that product, that's when you start paying us back. So you know that if the product sells faster, you pay it back faster. If it sells slower, you pay it back slower. And giving you that flexibility, you know that you'll never have any cash flow problems. You know that you can buy as much inventory as you want. You're returning it when it's sold. No one's going to come to you after 3 months, hey, pay us back some money, when you haven't even sold that inventory. And that way you can sleep well and be stress-free. And of course, you can now substantially grow and bring as much inventory as you need and meet the demand and the potential of your growth. And on the risk side of it, like I said, we're taking up to 75%. We can finance up to 75% of the risk at a very small amount of the profit, where the seller is making all the rest of the profit, even on what we're funding. On the ROI side of it, by the way, if in general you're putting $100,000 and you're going to make 70 to 100%, meaning on that investment you're going to make 70 to 100% ROI. When you work with us, if we put in $70,000 and you only put $30,000, and our fees are anywhere between, I don't know, 8 to 12%, let's say on average 10, you're still making 60 to 90% on our financed amount. So now on your $30,000 that you invested, you're going to make 200 to 250% return on to 300% almost return on investment. So you're improving your ROI, you're steadying your cash flow, you can scale and bring as much inventory as you need, and you're lowering your risk when it comes to risk mitigation. So these are the important things and aspects that we are bringing into our solution. I think I mentioned everything, and this product was created, me as a seller, people would always come to me, would you invest in us? We need to buy more inventory. And as a private investor, yeah, I invested, but I always took equity in the product. I mean, I'm taking the risk, I put equity. And those are the other solutions we see out there. There's no reason to do that. If you have a product that's selling for 6 months, if you've been selling for 12 months on Amazon, if your product is scaling and growing and basically makes money and is profitable, we can help you scale that product and bring as much as you need. It's less important to make high profits when you're still scaling and when you're still growing your business. Once you reach a larger quantity and a lot more sales, then you can always improve your profitability. When you're selling a lot more, you get better shipping costs, better manufacturing costs. Everything becomes more efficient, and that's when you start making more profits. So while you're growing, we're here to help. Once you're steady and you're making money, if you're not looking to expand or anything like that, basically you don't need us anymore. And that's what we're here for. If anybody wants to, well, let's skip. If anybody needs you can go to our page. There's a very short application. You can file with us. Usually within 48 hours, we can give you an approval for a PO that you want to finance, and finance it even a few days later if needed. And we'd be glad to help more sellers grow and expand. And anything you need, by the way, on the Amazon side of it, if you have questions in general, I'm available on my LinkedIn, on my email, nadav@capec.io. I'll be glad to help and answer anything. Thank you.
Awesome, that was really useful. I've not heard of a service like that, so that, yeah, I know that would be really, yeah, that would be really good. It sounded very good. I've got a couple of questions, but I'll save those for the Q&A if that's okay. Matt, you're up next with basically talking about 3 key profit drivers you can fix right now, if that's okay. I'll hand it over to you.
Yeah, great. Now I feel like everybody has been doing a commercial for me. So this has been great. Joe's been talking about how, he likes to dive into the numbers and how important that is. I'm 100% on board with that. He also said, it's the stuff that people don't like to hear. I agree with that too. People generally are a little bit off put by all the data and all the numbers, but I think at the end of the day, that's what we're doing here, right? The accounting is not sexy, but profits are sexy. And if they're not there, what are we doing, right? Nadav said the worst thing that can happen is you run out of inventory. I think the worst thing that can happen is if you're selling your inventory at a loss, right? If you're going to all that trouble and shipping stuff all the way from overseas and selling it and spending on ads and doing everything else, and at the end of the day, you haven't made any money, that's worse than running out of inventory, because what are you doing, right? Then you're just subsidizing the customers. So I'm going to run through 3 things I think that you can focus on in your business to make sure that you're not doing all that work for nothing, and what you might be able to get the most out of it for. Let's see if I can move this and slideshow from the beginning. All right, hopefully you guys can see this okay. Yep. Okay, so just who cares about me, really? The main point I want to mention here is we do have over 1,100 e-commerce clients that we work with on a monthly basis on accounting. So, sometimes there's gurus out there that tell you this and tell you that, but then, we're seeing the actual results, the actual numbers that people are really doing in their business. So you can't really BS with your accountant whether or not you're making money or how much. And we actually even do the books for some of those gurus, and not all of them are doing as well as you might be led to believe. But we're seeing the actual data on what's working and what's not. And here's the first thing that I think is super critical, which is what we've all been talking about, which is data, right? Using data to make your decisions, not gut instinct, not sort of what feels good. This is a numbers business. For some reason, and I think it's a lot of those YouTube and TikTok videos that make it seem like, oh, it's super easy. Order products, find something cheap on Alibaba, order a bunch of them, sell them online. It's so easy. You'll make all this money. This is not. This is a super complex logistics, supply chain, data-driven business. And to do well with it, you have to know what your numbers are, and not just your sort of, well, I bought it for $5 and sold it for 20, so I must be making money numbers. You have to know the real, true to life actual results. And like Joe was saying, when you've got returns and unsellable returns and lost inventory and long-term storage fees and all that stuff that's taking bites out of what you thought your profit was going to be, you've got to make sure that at the end of the day, there is still profit. So if you're going to go borrow money with Nadav, even after you pay his very reasonable fees, there's still enough left for you to make that business make sense. So having accurate, current, accrual-based financials is key to this decision-making. And if you're not doing that, you're probably not making the best decisions. And you might be thinking you're squeaking by with a profit. And at the end of the year, when you finally do everything, add it all up, you find out, nope, you've been making a loss all this time. So I think beyond just looking at financials, you've got to look at your key metrics on a regular basis all the time. Your cost of goods sold as a percent of income, when you factor everything that goes into that, the fees that you're paying as a percent of income, and making sure that's not creeping up on you, which they are if you're not careful. Ad spend as a percent of income, making sure that you're not just throwing money into ads and hoping it works, but really tracking what's effective there. Specifically, all these ad specific metrics, you've got to be looking at that carefully and making sure that every product is pulling its weight, and consistently fighting wasted ads expenses, software subs that you're not using anymore, SKUs that aren't profitable, losing inventory, not recovering that, just making sure that you're on top of all of it. And at the end of the day, it's all profit. If you're not consistently month over month being profitable in everything that you're selling, then you need to revisit that and fix that problem. But again, without the data, it's all just a guess, right? So if you're just tracking it, by tracking it, you can improve it. If you're not even tracking it, it's very hard to even know if you need to improve it. And just doing this, we've seen clients increase profit 10 or 15% just because they finally started paying attention. All right, data driver 2, the single biggest cost in the typical e-commerce business is your cost of goods sold. And what I see happen over and over again is people will start with one product and they will watch it carefully because there's only one to watch. But as they start growing their catalog, products start creeping in that either used to be profitable and aren't anymore, or they're adding products that are never profitable to begin with, but they've just got so much going on and they're watching so many different things that all of a sudden part of their catalog, part of their product constellation is not profitable. And that's dragging money out of the ones that are profitable. So you've got to make sure every month, everything you're selling is a positive contribution to the business. Otherwise, you've got to revisit it. You've got to make sure when you buy it, that you're buying it at a price that you can sell it profitably at. And again, it's just a numbers business. And if you're not watching the numbers, you could easily be getting this wrong. You've got to keep a close eye on returns. Exactly to Joe's point, this can eat into your margin like you wouldn't believe if you're not keeping a close eye on it, especially if you're in a category where returns can be a pretty big percent of sales. Packaging is another one. It's a great place to save money if your customers don't care and you're spending money on fancy printed boxes when you could be putting them in a 10-cent poly bag. Make sure you're not overspending. Also, you're not sending it in a package that's bigger than it needs to be, where you're paying higher shipping costs for no good reason. I see a lot of sellers, a lot of our clients, when I ask them, when was the last time you negotiated the prices? They go, well, when I placed the first order, we talked about it and it's never come up since. Well, every time you place a new order is an opportunity to renegotiate what you're paying, take advantage of it. The sellers certainly are. So you, as the buyer of the products, you should be negotiating as well, not just price, but quantity, terms, everything. And don't single source yourself. Just assume that the deal you originally got is still the best deal. We see this happen all the time with clients. After 2 or 3 years of buying from the same supplier, they'll finally go look around and realize they could have been getting a better product at less cost than their current supplier. And make sure that when you're selling, it's not just what you're getting the cost of goods sold or the cost that you're buying at, but also what pricing power, what are you building into the product to give you pricing power to be able to charge more of a premium. By just charging a higher price, you've automatically lowered the cost of goods sold as a percent of your sales. So think about it from all angles. These fixes, when we go through all these steps with clients, on average, they're adding 20% more profit by fixing all these various things that can be wrong with their cost of goods sold. And this is on products they're already selling. And then every time they add more products, they're going through the same exercise. But don't get lazy and forget to do this or stop doing it for stuff you've been selling for years. A lot of times there's hidden opportunity there. 3, ad spend. Of course, this is one of the other biggest categories that you have control over in your e-commerce business. Just make sure you know what you're selling and you're targeting effectively. I see so many clients using very generic keywords, wasting tons of ad dollars when more targeting and better research would have yielded much better results. And then they'll set it and forget it, but you can't set it and forget it because there's always new competition. There's always things coming along that change the landscape. So you've got to continuously monitor this, and doubly so if you've handed it off to an agency whose interests may not be totally aligned with your interests, depending on their pricing model, to keep your costs down. So you got to keep testing, keep trying new things, making sure you're getting the most out of your ad dollars. And one of the things we've seen with brands that have any kind of brand equity, and you can kind of see this if people are doing searches for your brand name, so the name of your product instead of the generic keyword for your product, a lot of times if people are searching for your brand specifically, the agencies will always say, well, you got to run ads to protect your brand to take that slot. But if somebody's looking for you, maybe you don't. Maybe they're going to scroll right past the sponsored listings till they find your product. And in that case, you can save a lot of money on basically competing with yourself for a brand that you have enough brand equity in that people will scroll to find you. So we've seen a lot of people save money turning off their own brand name ads, basically giving Amazon free money for a product that the customer was already going to buy anyway. And closely monitoring your ads and fixing your ad problems a lot of times can add a pretty significant profit boost. And the last thing here, I mean, Jeff himself said, right, advertising is the price you pay for having an unremarkable product or service. If you're selling something generic, you've got to spend ads to try to even get the attention of the person who's looking for something in that category. But if you've built a brand, then you can cut back on the ad spend and still have plenty of sales. Last bonus driver, in my opinion, and the most successful sellers that we see come through and be our, of our clients, are the ones that are really focused on the customer. They're not starting with the product research, randomly buying products here and there, trying to find ones with low review scores and low competition. Like, those days are pretty much over. The sellers that we see being most successful now are selling multi-channel, and they're focused on the customer first. They define a customer group that they're going to sell to, and then they pick the products based on what that customer group is going to be most interested in, and they build brand equity amongst that customer group. And once you've gotten to that point, everything changes. You can do much better targeting. You can target directly in Facebook groups that are people who are directly interested in the kinds of products that you're selling. You have better ad costs, cheaper ad costs, better conversions. You have better inventory control, even up to the point where we have customers who are sending out to their email list, hey, what products would you like from us next? And literally placing pre-orders instead of having to buy inventory and then hope it sells through. And you've got premium pricing at that point. If people are invested in your brand, they're no longer looking for the cheapest generic option. They're willing to pay more to buy from a brand that they know and trust. And the best part is, and a lot of people make their money in e-commerce businesses when they finally sell them. If you have a powerful brand with a good moat, you've got a much better value when you exit the business versus something, again, selling sort of just a generic collection of products that don't tie together and have no real moat or differentiation or competitive advantage. So my bonus tip is, as you grow your business, or if you start another brand, start with the customer, not the product, and you will find, I think, much better long-term success. You can add a ton more profit if you're selling your own branded product to your own customer group with little or no competition because of the unique value proposition that you're bringing to the table. All right, that is mine, and hopefully I didn't go too far over the time, and we'll leave some time for Q&A.
Yeah, no, that was awesome. Thank you. And like, just to add to that, like, a lot of the clients that we find that do the best are the ones that they started the product to solve a problem that they had, or a product they wished existed. So they had a product some of my favorite sellers that we work with are the ones that said, I built and made this product because I wished it existed when I was pregnant, when I was this, when I was that. And they actually end up having the best brands, the most loyal customers, and the most profit. So completely agree with that. So yeah, thank you everybody. That was really awesome, and I learned a lot from it, and much better than a lot of the Q&A stuff that I watch as well. So really appreciate that. I've got some questions here that I will start with, and I'll just do them in order of who was talking after myself. So if I'll start with Becky, if that's all right. So let me pull up the questions that have come in. So the first one is, someone said, how do returns and your return rate impact your profit margin, and how can I see my return rate and my standard return rate?
Oh, that's a good question. Returns definitely impact your profit margin. I think Joe was really diving into this more than I was. So Joe, I don't know if there's anything you want to chime in about here. But
I think Joe's not there, so to put you on the spot. I'll come back to Joe.
That's okay.
When he's back on that one.
Sorry. Can you repeat that? Can you repeat that?
That's right. Yeah, sure. It was basically, someone said, how do returns and your return rate impact your profit margin? When I see my return rate, is there a way to see it? And standard return rate, how do I see my overall standard return rate?
So say the question one more time. Sorry. Is there a way to see your return rate?
Yeah, there's a report in Seller Central.
Yeah,
the profit margin.
Yeah, so there's a few places you could see the return rate. I mean, there are actually in the sales dashboard, you can actually see it. It'll show it to you on an account level. But then there are reports. If you pull the return report, you might have to do a formula to see, based on the total amount of units that you sold and received back, you could actually get the percentage rate. But then actually what I've worked on the last few months with a few different softwares is to actually figure out as close as possible what the margin impact is of those returns. That's a little bit more of a conversation I think that I would have to kind of dig deeper with whoever is interested. But if anyone's interested, they could reach out to me and I could kind of walk them through it. But that's something I think everyone kind of touched on. They realize how big of an impact returns can have on your overall margin. I think Matt probably deals with it the most because he's an actual accountant, right? Or has an accounting software. So.
Awesome. This is a question for Becky as well. So how does monitoring the buy box benefit sellers, and and do you tend to see buy boxes at 100% as standard, or is it it's how does it tend to benefit sellers from having the monitoring service, and how does that work more?
Sure. Yeah. So you actually set up alerts on all of your ASINs with Seller Pulse, our software. And basically it helps you because it just automates, like if you have 5 ASINs, you might be able to go check that every day or have a VA checking that. But looking for things like buy box suppression, that's going to take a lot of time and it changes minute to minute. So we're actually just taking out the legwork and notifying you when there's an issue. And then our alerts are really detailed. So they give you like the winning offer details, the losing offer details. And that way you can see why you're losing, get an idea of what you need to do to be more competitive. And then if you need to take action, like we have an alert for a number of offers change. So if you suddenly have an unauthorized reseller on your account, we're going to actually notify you of that and then give you the information to send a cease and desist or take any steps that you need to with Amazon to open a case. So awesome. I hope I answered.
And
that's great.
Perfect.
That's great.
Yeah. Another one is what can sellers do to win the buy box more often? I know you covered some of that. I wondered if someone asked if you can go into any more detail on what you can do to win the buy box more often. Say you're either a new seller or you've because I know we work with new sellers. Sometimes they say we can win the buy box and so forth, and it's do we have to send an FBA or what would you suggest in terms of how to win the buy box more often?
Yeah, so FBA, seller fulfilled prime, is also a really good option if you prefer to fill orders out of your own warehouse. Obviously, if you're doing seller fulfilled prime, you're really trying to stick to Amazon's. They've got some pretty strict guidelines for that. But yeah, just being able to fulfill orders quickly is a big piece of the puzzle. And then making sure that your account health is really good. So that's where we get into the things like seller feedback, order defect rate, return rate, making sure your pricing is competitive. There's a lot that you can do. Unfortunately, there are just many, many ways to lose the buy box. So if you kind of look at that list, it gives you an idea of what you need to do to win the buy box. So making sure your listing is fully filled out, has all the details that it needs, making sure that you meet the buy box eligibility requirements, which you can find in Seller Central. But again, that's things like having a professional seller account, having inventory available, having a high seller feedback score, history selling on Amazon. The history selling on Amazon, unfortunately, it just kind of comes with time. So the longer that you're there, as a brand new seller, you might have a little bit of trouble getting traction, but hopefully it doesn't take too long.
Becky, I've also seen that at times if you have a healthy level of inventory, and when I mean healthy level, like a certain amount of days of supply that Amazon deems to be correct for that product's, sales velocity, that also helps with buy box percentage. Have you seen that?
Yeah, for sure. And we've been saying, for a long time, we were saying you want to have between a month and 6 months of inventory at FBA. But I think especially now, what you were just talking about, the low inventory level fee applies if your historic or your short-term and long-term historical days of supply are below 28, which gets a little technical, but basically if your inventory is too low at FBA, you're going to get charged. And then like Joe was saying before with the aged inventory fee, if your inventory is at FBA too long, you're going to get charged. So you really need to hit that sweet spot of having enough inventory, but
such a fine line. There's such a fine line. That's why I think Matt touched on it. Everyone touched on it. Constantly analyzing your data. Again, I think on a day-to-day is tough unless you're a bigger organization and you have, amazing people that can kind of pull the reporting together. But at least weekly, and if not weekly, absolutely monthly. If you're not really diving in monthly, I mean, once that starts to go into month over month, you're lost. I mean, I'm sure Matt sees it more than anyone. You know, how people think they're doing well, they're doing all this gross revenue, and then you look under the hood and you're like, wait a minute, after the money that I borrowed at the rate that I borrowed it at, after all my expenses, after the returns, after, uh-oh, nothing left. So, you know, making sure that you're really aware of that up front is important.
I've had people fight me on it, say, you know, there's no way my business isn't making money. I know I'm profitable. And I go, well, here's the numbers. I mean, I don't know how you can't argue with the data. You're not.
Yeah.
And sometimes they get mad and they're like, well, you're doing it wrong. I'm not, but okay.
I actually suggest to a lot of people, and you think I'm crazy, but and I was lucky enough in my experience in my previous life to be kind of in an organization that I worked very closely with the CFO. I worked for a very large wholesale clothing company. So I worked hand in hand with the CFO. He told me a lot of basic accounting, you know, all the things that you would need to know by reading a P&L. And it's really helped me in this business. I would say more than almost anything else. So when people don't understand how to read a P&L, don't understand a balance sheet, it's very hard to really run a well-oiled machine on the Amazon and in the Amazon world. Right, there's so many moving parts. You need to know what's an expense, what could be, you know, marked as a CapEx expense. Maybe there are certain things that, you know, a lot of people will tell me, I don't want to invest in an ERP system. And I'm like, why? They're like, well, it's too expensive. I said, okay, but if you have the money, you know, it's not going to kill your P&L. You could kind of, you know, chop it up over, you know, 4 or 5 months, 6 months, and it's amortized. Like, they're like, what are you talking about? I'm like, okay, you need to go take an accounting class so you can understand how you need to invest in your business. You know, a lot of these things it's becoming imperative. It used to be a little bit more. Anyone that's been selling on Amazon, you'll feel me on this. 10 years ago, you could do whatever the heck you wanted. You were probably making money because margins were higher. The fees were a third of what they are now, and you were probably fine. If you didn't check it every month or every week, you were still good. Over the last 2 or 3 years, if you're not an absolute hawk, you're missing a ton of things. You're missing a ton of things.
Well, and that's what happens is a lot of people get drawn into this business because they're listening to people who are talking about how they did so well, but how they did so well was they were doing it 5 or 6 or 7 years ago, and it's not the same today. And so when people tell me, oh, I don't like numbers, I'm not a numbers person, I'm like, well, this may not be the business for you, because this is a numbers business.
There's a
You know,
lot.
I said that I said that the other day. I say that all the time. I said when I sold my businesses, it was like 7 and 10 years ago, and I'm 10 times the seller I was when I sold them. You know, my old self would have died in Amazon now, like, frankly, you know, so that's why I'm not rushing to get back to it either. To be honest, it's, you know, you've got to have you know, from a personal point of view, you've got to have a great product. You know, as well nowadays. Back then, it was just, you know, it was the whole Alibaba and etc. And you know, and it worked. But anyway, Nadav, there's a question for you, which is basically, what are your sort of minimum requirements for borrowing, and what's your sort of, what does your ideal sort of borrower look like, really, I guess, in terms of like how long you've been selling, or you know, and that sort of thing.
Yeah, so like I said before, 12 months that the business has been selling, 6 months of history from the product itself, that actual SKU that's selling. Obviously, we prefer seeing SKUs that are growing in revenue and are selling more and more. By the way, also we're able to take sellers from all around the world, as long as the inventory is going to be sold in Europe or in the US. We don't put a lien on the business. We don't check credits. We don't have personal guarantees. So it doesn't matter where the seller is located or where his business is set up. We're basically just on the inventory. So we're pretty open to almost everyone in that way. And we do look at profitabilities. We look at all the data points that everyone's been talking about here. If you're not profitable, most likely we're not going to finance you. I mean, we'll come back to you and we'll tell you, hey, your tacos is too expensive, your cost of logistics is too high, your sales cost is too low. You know, if you're not making money, we're not going to finance you. So you'll also get an audit on that when we look into your product.
Awesome. No, thank you very much. I've got 2 last questions before we are done, and one of them is for Matt, and it is, it's here, one moment. It is, what should I be spending on a tacos total ad cost of sale to be profitable? What would you recommend a tacos to be? So
well, I mean, that obviously depends a lot on what your product is and what your margin. So there's not one easy answer. But if I just was going to sort of benchmark in general, any amount over 10% that your ad cost creeps up. So this is for, private label sellers as a percent of revenue. If your ads are more than 10% of your revenue, for every percent it goes up, you're probably cutting into profitability. And when we see people come to us and they're spending 20 or 25% of their revenue on ads, it's almost impossible that they're also profitable unless they have just a super low cost of their product, a very unique, branded product that they're getting for a couple of bucks and able to sell for $29 or $39 a unit. But by and large, for most, just general, very broad rule of thumb, 10% and under is a good target for your ad cost as a percent of your revenue. But again, it's very specific to each seller and what else they've got going on. And, it's hard to give one direct answer. What we do when we work with clients is we look at the whole picture and then come up with KPIs, benchmarks for them to kind of aim for to get. And if they're hitting those benchmarks, then they should be profitable. But that 10% number is just sort of a broad stroke guess for most sellers.
Sure, that sounds right. And also, like, I guess how long you've been selling. Obviously, you have to come in with a higher tackles quite a lot of the time. It's so otherwise it spooks people when they're sort of 50% tackles at the start, and that's pretty standard. So
right. Well, launching a new product or getting in is a different story. But once you're established,
sure. You makes sense.
Rob, so just I mean, it's a really good question, and so often people ask that percentage of. It's a sort of slight bugbear of my own. I really just don't think, and Matt, as you said, it's so difficult to answer the question in percentage terms. And in my opinion, it's the wrong question. Because what you need to know is how much can you afford to acquire a new customer, and then that has to be translated based into a lifetime value calculation and not just an average order value calculation. So we have a very simple tool called the margin calculator, which has all those inputs that I'm sure Matt has at his fingertips. But it's very, very simple to understand how much you can afford to spend to effectively break even, or if your lifetime value means you can afford to lose a bit of money and you understand how the cash flow works in order to then make that profitable. In my opinion, that's how you come up with the answer to that question. Anybody walking away from here with a percentage in their mind, in my opinion, is going down the wrong route.
Well, right. I mean, that's a quick and dirty answer to a question that really the bigger thing is, like I tried to point out, right? I think if you're thinking in terms of customers, that's the direction to go. If you're thinking about, I sell bedding products and I'd like to capture a customer that I can eventually sell pillows and pillowcases and sheets and a mattress topper and a bedside lamp, and all in over 5 years, that customer could be worth $5,000 to me. Well, then yes, you can spend $250 to acquire that customer and still be in great shape. But if all you're doing is making a one-off sale, you'll never see them again, you'll never sell anything else to them, then you've got to make sure you're making money on that one single sale. So it all sort of starts from the beginning with, what are you even doing in business, right? What's your long-term goal? Who are your customers? What are you planning to do? And then you can back into some of the numbers that would make sense for your business. But I think trying to, the very short-term one-off product sale, I've got to make money on each sale because I'll never see that customer again. That is a very tough business to be in.
I could probably, Matt, you and I could probably do an hour just on this topic. I suspect. So we probably both have very clear views, but exactly that. It's a really important to understand the total business aspect of what you're doing when you're making up to how much can you afford to spend to gain these customers.
Yeah, well, like most of it, it's like it depends. It's normally the standard answer, isn't it? And it's because it depends on everything. And I get asked like, what's my total profit going to be in year one? And I've only just looked at the account and how much inventory shall I order? Those are the two sort of standard questions, tricky ones. But anyway, thank you very much, everybody, for joining me and putting up with my first webinar experience full of glitches and so forth. But I really enjoyed listening to everything that you had to say, and yeah, and I'll share the recordings with everybody, and there are links here in the chat for everybody to get in touch with everybody that's been on the webinar as well. So yeah, much appreciated for being with me, and yeah, and thank you very much.
All right,
Thank you.
thanks.
Thank you.
Bye.
Thanks, guys.
Bye.
Take care. Bye.